There is a way you can make free money in the stock market. And no, this isn't one of those scammy guru 100% win rate strategy type videos. We are going to be discussing the wheel strategy, and it involves options. I know options can be complicated, but I have traded this strategy myself enough that I promise you I will be able to explain it in a way that anybody can understand. Let me give you a scenario. Say you want to buy Nvidia, but not at current levels. You want to buy 100 shares of Nvidia at $120. If that is a scenario you've ever found yourself in, if you simply go out and put an open order at $120 waiting for it to be filled, you are simply missing out on free money. Risk has value in the stock market, and the options market allows you to sell that risk. If you have an open order out on Nvidia at $120 a share, that is risky. For all you know, Nvidia could just fall through $120 a share down to $100 a share, and you're down 20% or whatever it is. So you might as well, if that is your scenario, if you are going to buy the shares of Nvidia at $120 anyway, you might as well also sell some of that risk to someone willing to buy it. A put contract represents buying downside risk, and people are willing to do that. People are willing to risk that by a certain date, Nvidia will be trading less than $120 a share. They are just out there and waiting for someone to sell them that risk. In fact, if I flick over my view here, over 18,120 strike put contracts that expire in less than a month traded on Nvidia today. A single options contract represents 100 shares. And what a put contract represents is the option to buy the underlying equity at the strike price on the expiration date. So on June 20th, which was the expiration date for that options chain that we just looked at, say Nvidia is trading at $110 a share. If someone owned one 120 strike Nvidia contract, they would be able to sell 100 shares of Nvidia at $120 each. Since they are selling something worth $110 at $120, that means that they profit $10 per share. 10 times 100 being $1,000 in profit. Except it's not all profit, because remember, they had to buy that risk. They had to purchase the option to sell the contracts at $120. That is called options premium, and that is represented by the price that they bought their contract at. The current bid of this 120 strike put is at 81 cents. You multiply that price by 100, as that is the leverage price of it. It represents 100 shares. So the cost of one single contract cost $81. You would subtract that $81 from the $1,000 total that they would have made, once again, if Nvidia expires at $110 a share on the 20th of June. So that's the buy side opportunity. That's why people are willing to buy your risk. But that's not us. We are not buying this put. Remember, we want to be the ones selling the risk. We want to be the ones writing the contract. Since we are willing to buy 100 shares of Nvidia at $120 a share, we are willing to sell our risk at that level. So we would be the ones profiting $81 for every contract that we wrote. If we wanted to buy 100 shares, of course, we would just write one contract. As soon as you sell that contract, the money is in your account. You have made $80 for every contract that you sold. Congratulations. Now, there are two outcomes. On June 20th, Nvidia is trading greater than $120 a share. If that's true, nothing happens. Congratulations, you got to collect a free $80. Now, the other scenario, on June 20th, Nvidia is trading at $110 a share. You now are obligated to buy 100 shares of Nvidia at $120. that kind of stinks because you're immediately going to be down $1,000 in that position. But you get to collect the premium still anyway. Remember, that $80 is already in your account. That money is yours. Just because you are obligated to buy and just because the put expired in the money, they call it, the options contract premium that you sold, you still get to keep. So remember, the very beginning of this, I defined this scenario. You had an order out to buy 100 shares of NVIDIA at $120. If that were true, you were going to buy there anyway. You were going to be down $1,000 in this position anyway. You just now got to collect free premium on top of that, and not to mention the likelihood that NVIDIA is trading less than $120 by June 20th. I actually believe you can see that percentage. Yeah, the probability out of the money. There's an 86% chance, this is what the options market is currently predicting, there's an 86% chance that NVIDIA will not be trading less than $120 by June 20th. That means there is an 86% chance that you are just going to get to collect the free premium and then you can roll it out another month. Say then you go to whatever, you'd go to like July 18th and you look for 120 and then you would sell these contracts and look to collect more premium while you're waiting for the underlying stock to get to your price for entrance. That's only the first half of the wheel strategy, so don't go anywhere. Plus, I have some better strategies for finding better prices to sell these contracts at that we'll discuss later in this video. But are you beginning to see how it's free money? It's free money, not in the sense that you can't lose. You can definitely lose. If NVIDIA once again goes down to $110 a share, you're going to be down $1,000 on your position. But the point is you were going to be down $1,000 on your position anyway. If you were going to buy shares at 120 and hold NVIDIA long term, that was already like in the future for you. That was already your fate. You might as well just collect the premium on top of that. Now, hey, you're only down $920 because you got to collect $80 of premium, which I know doesn't sound super helpful, but it's better than nothing. It's free money, right? Before moving on to the second half of the wheel strategy, I just want to say quickly that unless you are approved within your account for advanced option levels, what's going to happen when you sell puts? They are going to be called portfolio secured puts. Basically, what that means is you cannot sell more than what is in your account. So if you want to sell a options contract at 120 on NVIDIA, you need to have enough money in your portfolio to be able to afford 100 shares of NVIDIA at $120 a share. All right, so worst case scenario on June 20th, NVIDIA is trading at $110 a share, so you are obligated to buy 100 shares at $120. You finally end up getting filled after what will likely be months of not getting filled and collecting free premium, but now you are in this position. What comes next? Well, now you own 100 shares of NVIDIA. So now you can come back into the options chain. We can go another month out. Once again, let's move down to this July month. And now we look on this side of the options chain because the second half of the option wheel strategy is you can now sell a covered call against that position. Once again, an options contract represents 100 shares of the underlying. So if you own 100 shares, you can sell one covered call. So say on July 18th, you are willing to sell NVIDIA. Once again, pick a price that you would be willing to sell at. Like, hey, if NVIDIA gets back up to this high here at 150, that is where I will lock in profit. Once again, instead of just having that order out, that risk sitting out there, just waiting, you can go sell that risk again. And yes, locking in profit is risk because what can happen? On July 18th, NVIDIA could be trading at $120 a share. You're going to be forced to sell at 150. But once again, the scenario we talked about, if that was your goal anyway, if you were going to sell NVIDIA at $150 a share anyway, then selling the premium there is like free money. So you would go sell this contract here, which is currently trading at $263 a contract, but we are sort of offset. There's an extra month of time built into this contract right now, so it wouldn't really be worth that much. It'd probably be worth about $80 again if we were in a similar scenario, but whatever, that doesn't really matter. You would go sell this contract, and once again, what are the opportunities? What is the likelihood that it expires out of the money? I already have it loaded. Probability out of the money on that is currently sitting at 78%. There's a 78% chance that NVIDIA is not going to be trading at $150 a share on July 18th. So it's going to happen over and over and over again where NVIDIA doesn't get there. You get to collect the premium. Remember, once again, as soon as you sell the options contract, the money is in your account. So whether it expires in the money or out of the money, you've already profited what you sold the options contract for. Once again, there is just that risk. There's that risk that NVIDIA is trading way above 150 and you still have to sell at 150. But it's going to happen, I promise you, from someone that's done this. There's going to be months and months and months where you are just selling contracts, getting to collect free premium. Then eventually you will get hit, but even when you get hit, you still get to collect that premium. So once again, if you were going to buy at 120 and you were going to sell at 150 anyway, if that was your plan anyway on this ticker, then selling the risk is free money. And once again, I just want to clarify, because I keep saying free money, it doesn't mean you won't lose. You will lose money sometimes trading the wheel strategy. It's going to happen. It's inevitable, just like any strategy that exists. The idea is, if you're based off that first scenario where you had a price where you wanted to buy and had a price where you wanted to sell, you were already going to lose that money anyway. The premium is just some extra insurance against it. You are already accepting the risk. You might as well sell it, right? Anyway, let's now move on to a different scenario where it is not so much free money, but you get a little bit more aggressive with the wheel strategy. You get to target a little bit higher premiums and try to make a little bit more money trading like this. So rather than having a price that you know you want to own a certain stock at, let's just say you know you would be comfortable owning a certain stock. There's a stock out there that you feel safe enough that, hey, even if the thing dips, I'm very happy to own it. What you can do then is you can use a strategy that targets specific options Greeks to maximize your profits on the option wheel strategy. What I'm going to do now is I'm going to go over how I personally trade the option wheel strategy. I'm not telling you it's the best way to trade it. I'm not telling you to go do this, right? I'm just going to give my firsthand experience, okay? So say I want to own NVIDIA. NVIDIA is a stock that I'm like, hey, even if this thing drops a lot, I'm very happy having it in my portfolio. So let's go take a look at the options chain. And specifically, of course, we don't own it yet. So what is the first step of the option wheel strategy? We want to sell some puts on this underlying name. What I do, I have loaded up now my Greeks of Delta, Gamma, Theta, and Vega. I look at this Delta number. What Delta represents is the amount that the contract will change for every point that the underlying goes up. So NVIDIA is currently trading at $135 a share. If it goes up to $136 a share, if this Delta is sitting here at about 30 cents, this contract will go down 30 cents, right? This put will lose 30 cents if NVIDIA goes up a point. Well, that's what I target. I find monthlies, I like to trade the monthlies. They tend to have higher volume and higher open interest than the weeklies. So I will find the nearest monthly. I'm going about a month out in my expiration date. So once again, right now, today is May 30th. I would jump to this June 20th and I would sell the put trading the closest to 30 Delta. That would give me the price that I am comfortable buying NVIDIA at. So once again, unlike the free money of me like wanting, you know what, if NVIDIA gets to 120, I'm going to buy it. So I may as well just go sell that risk. I'm allowing the options chain to provide that price to me, to give me the risk that I am willing to take on. The 29 delta or 30 delta a month out currently sits at $129 a share, which is currently selling at $248 a contract on the bid. So I could sell one contract here for $248. Once again, what is my probability of out of the money? $129 is a 67% chance that I'm not even going to get filled. Once again, you all know by now, if I don't get filled, if on June 20th, NVIDIA is still trading above $129 a contract, great. I just get to collect the $248, roll out another month, and do the same thing. Obviously, if NVIDIA is trading less than $129 a contract, I have to buy 100 shares at $129. I still get to collect the $248 of profit. You know what that means, by the way? That means then that gives me a break-even price of about $126.52 if I just did that quick math in my head. Because even if it's trading at 128, oh no, I'm down $100 because I have to buy at 129, but I got to collect $248 a premium for selling that risk there. So actually, I'm up $148 in this trade. Does that make sense? So a little bit of extra cushion there as well, which is nice. And obviously, what's the second half of the wheel strategy? Once I get filled at $129, once that does eventually happen, I then jump out and I do the same thing. I would go another month out, but I would find where the 30 delta is on the call side. Right now, I see a 31 delta at $142 a share, trading at $220 a contract. So once I am filled my 100 shares, or a couple hundred, if I have sold a couple hundred contracts, I would then go sell those covered calls at that price, at that month out, and 30 delta. Once again, 30 delta and a month out is the way that I go about it. I'm not telling you it's the best. I'm not telling you to go do it. I'm just sharing my experience. A little bit of a different one today, folks. We didn't talk about custom coded strategies at all today. Hopefully you all enjoyed the sort of options conversation. I get a lot of comments asking me to talk about options. Figured I'd throw one out there for you today. If you are new to the channel, custom coding in Thinkorswim is the niche that we typically cover here. If that's interesting to you, make sure you subscribe to the channel. Also, in the description down below will be a link to my website in which I have published over 150 custom coded strategies, studies like these backtest labels you're seeing in the top left, even stock scanners, etc., etc. There's a handful of free ones over there, so go click on the link in the description and at least take advantage of the free codes. If you think it's something that could help accelerate your trading journey, then feel free to sign up. Anyway, hit like if you learned something, subscribe if you would like to continue learning, and YouTube thinks you would like this video right here from me. The algorithm's pretty smart, so you should probably check it out.